Ooh, I like this. Is the infinite banking slash bank on yourself finally being held accountable? Oh man, this is great. Now, I very rarely get on LinkedIn. I've started to do more and more. I'm starting to post my videos on LinkedIn and stuff because might as well take advantage of while I can until I'm banned completely from my challenges to the orthodox. My man Andy Panko had this. This is good stuff, man. I'm stoked by this actually. It's great to see insurance companies starting to get serious about reining in misleading sales practices. Mass Mutual recently issued an internal notice to all salespeople regarding the misleading sales practice of selling whole life insurance as a personal banking strategy. Oh. The gist of the strategy is to borrow against the cash value of the policy with a pitched assumption that the interest credited on the policy's cash value will consistently be larger than the interest expense of the loan. Hence a positive arbitrage, where taking on the debt of loans against the policy will result in the cash value contributing to positively compounding and grow over time. The Mass Mutual notice states such strategies are misleading to consumers in violation of insurance law and regulations by positioning the policy as a checking, savings, or retirement vehicle as something other than life insurance. I'll give you my thoughts here in just a second. It also says, due to policy holders being encouraged to consistently borrow against their policies, such strategies result in policies having a higher lapse risk if the customers do not fully understand what the hell they're doing, especially in rising interest rate environment. Hopefully other insurers will follow as some summarily put their feet down on misleading in violation of insurance regulation sales practice. While the Mass Mutual notice doesn't directly address the sales practices around index universal life insurance, because Mass Mutual doesn't sell those, it's logical to believe other insurers may eventually start to crack down on misleading sales practices that position these products as something they're not. Yeah. Just like it's in violation of insurance regulations to refer to whole life insurance as bank accounts, retirement vehicles, or something similar is likely not kosher. How dare. From a regulatory perspective, to pitch IULs as funds. The laser fund, yes, the laser fund. I used to get a lot of emails about the laser fund. I could not. I did a couple of videos a couple of years back. That was the laser. Oh. It's so. I don't want to say more because I'll get in trouble. All right, I had a. Let's see what kind of comments we got here. I had a guy. This guy was a rookie. I'll never forget this. Probably 2019. I was doing a live stream. This guy was adamant. He was new. I knew he was with Mass Mutual. He didn't say up front, but I knew he was because I've been around. Dude, I've been in this business since my 26th year, my friends. I'm such a gray beard that my hair is messed up. All right. Anyway, and I'll never forget. He said, "Well, we have a interest rate at Mass Mutual 6%." And I said, "Do you now?" He goes, "Yeah, we do 6% interest rate." I said, "Okay. So give me an in-force illustration. I dump $100,000 in there. What's my cash value after 10 years? It should be $160,000, 6% interest rate. And I'm not. That's just simple interest, all right." And he said, but this couple. We came back on a different live stream. He jumped on there. He said, "Well, it's not 160 after the first 10 years because of cost of insurance, sales commission, all that." I said, "Okay." So I said, inherently it's not a 6% interest rate, dude. Come on. And then he said, "Well," and I said, "Okay, well, all right. Well, how about 20 years? What's your cash value guaranteed after 20 years if you're paying a 6% interest rate?" Because Mass Mutual's been paying this for years and years and years. And this is not a bash on Mass Mutual. I actually like Mass Mutual. I'm a big fan. I don't like the sales practices that revolve around this crap, though. It's not Mass Mutual's fault. It's this guy he wasn't trained properly, or he was trained badly to push something that wasn't there. I said, "So what's do me an in-force illustration or a projection, I should say, for 20 years? What's the cash value then? All right, let's say it's not even 200 and it should be $220,000. Yeah. Let's say it's 180. Nope, not even close, because of cost of insurance and the fact of sales commissions and all that. Remember, the interest rate you're getting is a crediting rate. It doesn't mean crap. I could credit you 12% all day long, but it was costing 11% to have the policy in force. You're only getting 1%. All right, so you can't. That is a bad sales price. That drives me crazy. They do the same thing on variable annuities too. I cannot. I've stated this till I'm blue in the face. Variable annuity. I don't have my one pile sit on my lap, so I can't get my thing here. Else I bother the sleeping baby. I don't want to bother the sleeping baby. Variable annuities, they have two sorts. They have basically a shadow account and a real account. The shadow account is your income account. So people say, I'm getting it. I literally have people even to this day saying they're getting 7% a year guaranteed on their variable annuity. I says, I walk away money. And I know what it is. I mean, it's their income account. So basically they'll say, you put $100,000 in there. After 10 years, it'll be worth $200,000 for which you can take 5% a year off. That's what that means. You cannot walk away with $200,000. So it's a shadow account. So you say, I put $100,000 in. I'm guaranteed within 10 years I'll have $200,000, of which at that point I can take 5% a year off without any risk. And there's nothing inherently wrong with that strategy, by the way. But it's not a 7% guaranteed on your cash. You can't get a check cut to you in 10 years for $200,000. It does not work like that. And it drives me crazy that these insurance guys, they drives me up the wall. All right, so let's see what's. Oh, and then part 3, 420, on the infinite banking stuff, dudes. People have no clue the tax ramifications that could happen if the policy lapses. I used to be at USA. We never did this stuff, right? Infinite banking, but they issued a lot of life insurance, what they call permanent insurance. A lot of people would think that's whole life. No. Universal life, all right? Universal life, the risk is on you, the insured. Whole life, the risk is on the insurer, because literally it's contractual obligation, whole life. You, the insurance company, offers me a policy. I'm the insurer. As long as I do my what I'm supposed to do, give you $1,000 a year, you're guaranteeing a certain level of cash value and a certain death benefit. As long as I keep track of my contractual obligation, which I don't have to, but they have to. As long as I play the role of the $1,000, $2,000, whatever it is, they are on the hook for a whole life. All right. Universal life's not like that. Universal life contingent on interest rates, and cost of insurance, and all that. It's not. So the insurance company is not on the hook at all. All right, which means they can offer a little bit higher interest rate on the initial end to get you to buy. So what happens now is they used to issue these life insurance policies, drove me crazy, in lieu of doing survivor benefit. So if you're an 05 major retiring from the Army, you get a $30,000 a year pension. You can take might cost you $300 a month for 30 years to do a 55% survivor benefit. So when you die, your spouse will get $22,000, whatever it is. So a lot of guys will say no, and not just out USA, all over the place. No, just buy a life insurance policy, universal life, and take that $300 a month instead and put into a life insurance policy, and you'll have the cash value, access to it as well, and you'll leave your wife a significant tax-free benefit of life insurance. All right, that's great until the premiums don't pay the benefits anymore, or the premiums don't cover the cost of insurance. And once the premiums don't cover the cost of insurance, you're dipping into your cash value. I know this is very complete. You don't have to. It's okay not to quite understand what I'm talking about. It's fine. I just want you to know you're pulling into the cash value. When you're pulling down the cash value, you're going to make that policy lapse before you do, essentially. And when that happens, your wife is now, you're dead at 77. There's no life insurance. Your wife is like, what happened to survivor benefit? Oh, it's gone? Ooh, yeah, because the policy lapsed. Happens all the time. Bad sales practices, bad sales practices, which have big ramifications for survivors. So I like this. It's good stuff. I'm very happy to hear that Mass Mutual say, no, don't use our policies against us. Reverse arbitrage is not like, see, that's the thing too, is it ticks me off. It's not like Mass Mutual. I mean, it's not like they're dumb. It's not like they're dumb, but if everyone starts using this reverse arbitrage, the whole thing just collapses like a house of cards. You can't have that, dude. You can't have that. There used to be in variable annuities. It was Pacific Life too. They used to have this. I can't remember. This was 20 years ago, but you used to be able to roll like 95% of a Pacific Life. You do what's called 1035 exchange into a new annuity, and you get paid commission on that new annuity. So a guy had $100,000 at Pac Life annuity. You do a 1035 exchange to a new one. I never did this, but this is what used to the contract allowed it. And what would happen is you leave $5,000 with Pacific Life, but you would retain the death benefit of $100,000. It was nuts. So now you got a death benefit of Pacific Life by leaving $5,000 there, that $100,000 death benefit, and you've moved the rest of the contract to another firm, and you're basically doubling up your death benefit, and Pac Life is the one taking the risk. Now you can argue that was stupid for Pac Life to have that. Yes, it was. It's stupid actuarial. There's no way. I don't know who the hell they hired. They might have hired a 57 gender done to his head from the hole in the ground. I don't know. What I'm saying is, stupid. But at the end of the day, if everyone were to do that, it's going to collapse. And you can't have insurance companies collapsing, or else completely people say, why buy an insurance? And insurances are catastrophic issues. Yeah. I'm glad to hear that. I'm glad Andy pointed that out. It's good stuff. Love your thoughts. We'll see you.